All right, let's take a look at some of these Chapter 7 exercises. The first one, all right, we're going to be looking at calculating your cost of goods available for sale, ending inventory, cost of goods sold, excuse me, gross profit. And again, this is all under going to be the periodic FIFO method. So in this particular problem, you'll notice we've got from July 1st to the 31st, they give you beginning inventory, what they purchased, what they sold, and what's left. Notice the beginning inventory cost is 10 bucks, but notice it did change to 13 on these new purchases, so that the prices are changing. And of course, there's going to be your unit selling price. All right, so taking a look at our formula. So remember, this is our beginning inventory. You add your purchases. That equals cost of goods available for sale. And again, note, we've got the totals right here. And then, of course, ending inventory, there's 200 units left. Again, under FIFO, since they sold 100 units, we know that they would have sold 50 from that beginning inventory and then 50 from this purchase. So there's your 100. So your cost of goods sold would have been 50 at 10 and 50 at 13. They're showing you that right there. That's your cost of goods sold. And of course, your ending inventory is going to be what's ever left. So you're going to have 200 units left at 13 bucks. They're showing you that right there. So again, here's your formulas. Beginning inventory plus your purchases equals cost available minus ending inventory equals your cost of goods sold. And of course, once you've got your cost of goods sold at $11.50, you know that you sold it at $1,500 because that's your sales price. So sales minus cost of goods sold equals your gross profit. All right, same thing, but this one's under the Lifo method. So remember, Lifo was last in, first out. So notice that, again, you have 100 units of sales, but the Lifo is going to say you're going to go from this pool first. So there's 250 units in this pool of purchases. So your cost of goods sold is going to be 100 units at $13. So they're going to show you that one right there. So notice you haven't even touched the beginning inventory yet. So what's going to be left is you're going to have for ending inventory, you'll still have that 50 units at 10 bucks. And then you tapped in at 100 units out of this 250, so 150 is left at 13. So that's how they would get that ending inventory. And of course, now you can get your cost of goods sold and gross profit calculation. Again, notice how it's different under Lifo versus FIFO. All right, same thing. This is going to be the periodic weighted average. So again, same formula. Notice your total cost divided by 300 units, your average cost is $12.50 per unit. So that's what you use as cost of goods sold. Notice it's costed out at $12.50, and your ending inventory is also averaged out at the same cost. So that's called the weighted average cost method. And then you can do your cost of goods sold gross profit calculations down here, and you can compare that again with the other two methods. All right, so again, same thing. We got the three different methods, and we've got, I'll just kind of jump to the last part that says, given the following information, they want you to get cost of goods available for sale, ending inventory cost of goods sold, if they use FIFO, Lifo, or the weighted average methods. So again, here we go. We've got the beginning inventory at 40. They sold 1,000. They purchased another 6,000 at 44. Notice the prices are changing. They sold another 3,000, and then of course they purchased 8,000 at 50, and then they sold 5,000. So you can see how your inventory prices are not the same, they're not constant. So each one of these methods should yield different results. All right, so looking at this one, and notice it says cost of goods available for sale would of course be the same for all methods because it's the same total cost. So notice it's just going to be about timing of when those costs get expensed. So notice we've got a summary of all of our purchases. Here's a unit cost, and then there's the total cost. And again, note, here's the dates. So under FIFO, Lifo, depending on when the sales took place, we'll be taking them out of different cost pools based on the timing, whether it's FIFO or Lifo. So you'll notice, again, under FIFO, they had 7,000 units left at 50. And then you can see how when they went to do their cost of goods sold, first in, first out, the first 2,000 came out of 40, and then you had 6,000 at 44, and then 1,000 at 50. So your total sales, which were 9,000 units, you can see how they use these different cost pools to arrive at their cost of goods sold. And then when you compare FIFO to LIFO, if you look at its cost of goods sold, notice you still have 9,000 units of sales. But notice they got the most recent purchase at 58,000 of those units, and then they only dipped into the next cost pool, which was at the 44 cost pool right there. And you can see then how the ending inventory is also different. You still have 7,000 units in total, but you can see how the LIFO didn't even touch that beginning inventory. All right, and then of course here is your weighted average method. You just took the total cost divided by your total inventory. 4,650 is your average. You just multiply that by 9,000 to get your cost of goods sold, and then that times 7,000 to get your ending inventory. Okay, so again, on this one, it looks like we are looking at, again, the 3 different methods. And notice once again, in terms of goods available for sale, the total cost is going to be the same for all 3 methods, all right? So notice we've got beginning inventory units. January 15th, we got more units coming in at a different cost. And then at the 24th, once again, more units coming in at a different cost. Again, there's our total cost. So we've got our totals. And then let's go to the next slide. And let's take a look at the number of units in ending inventory. And again, on this one, you'll notice that, again, if they sold, it looks like 460 units is going to be our sales in this case. So we can figure out units ending inventory equals your units available minus units sold. Units ending inventory, of course, would have been 460. Again, there's your sales units of 240 right there. So 460 units would be left. All right, now, so if you then want to get to your cost of goods sold, you got to figure if they sold 240 units, if you're using the FIFO method, you'll first start by taking 120 out of the first pool. If you'd be using the LIFO method, you're going to start by costing out that 200 first because that's the last one that came in. All right. So first one, again, is under the FIFO method. So again, they sold 240 units. So we know for the cost of goods sold purposes, we take 120 at 80. They're showing you that one right there. And then you need another 120 units out of this cost pool. And that would be at 90. Add those together, you get 20,400 as cost of goods sold. Ending inventory, what's left over would be that 200 at 110, which is right there. And then you still have 260 units left out of 380 at 90 bucks per unit would give you ending inventory of $45,400. All right, then under the LIFO method, again, last in, first out. For your cost of goods sold, you start at the last one in, that's 200. So there's the 200 at 110, and then you need another 40. There's the 40, you go to the next layer out of this layer at 90, add those together, there's your cost of goods sold. So what's left would be 120 at 80, that's part of your ending inventory. And then you still have 340 units left out of that pool at 90, that would be your ending inventory. All right, weighted average. Again, they came up with a total average cost of 94, and that's pretty easy. You just take your ending inventory units and your cost of goods sold units and then multiply by that average, and then that's going to be your cost for ending inventory and cost of goods sold. All right, on this one, we'll take a look at a lower cost to market problem. And you can see here we've got different units. We've got what they call the net realizable value, the write down, the quantity on hand, and then the total write down. So it says complete the table column, write down per item, and then sum the final column to compute the amount of the total write down using that lower of cost or market rule. All right, so on this one, let me pause this, and then just to kind of break up this illustration, I will start a new video, and then I'll start with this exercise showing you the lower of cost or market calculations.